Alright, guys. So today's session was designing portfolio investing strategy and exit strategy. We'll see if we have time to get to the exit strategy. Like all VCs, exits are very hard. So we will see if we can get there. Uh, in the meanwhile, I want to start off with this quote. Chris Duos runs a fund of funds, and he was an LP. He wrote this very interesting quote, which is the most meaningless number in sports, the score at the end of the first quarter of a football game. So much will happen before the final whistle sounds that the first quarter score is specious predictor at best. And I think that holds true significantly for uh, the sport we are in, which is the VC investing sport. We get excited by the Series A, Series B, Series C valuations, and until the game finishes, until the company goes public, until you liquidate your holdings and you get the money back, all those valuations are essentially just a specious predictor at best. And you guys are very fortunate. I'm also very fortunate that we are all living in times where we are seeing these multi-billion-dollar companies which have won IPO, and companies that seem untouchable are essentially going through a massive down round corrections across the board, right? So, and this just puts back the humility when we are looking at our own valuations, right? So I think that is supremely important when you start off and think about returning money from any VC fund. So starting with that, I just introduce myself. I'm a partner at Accel. These are some of the investments I've done. Been in the VC industry for now close to 9.5 years. Was a techie at heart, being a software engineer, a programmer, product manager. And obviously, I think all of you know Ritesh anyways. The interesting bit is Ritesh and I crossed paths at Adobe. So both of us worked together at Adobe at one point of time. And Ritesh was one of the reasons I was able to enter into the VC industry as well. Like he's a mentor and teaches me till date. Right? So I learn from him, as well as Anand and Gagan, who are also on the call, and Madhukar as well.
So the first when I asked Prayank who else should we invite, the first name he was like Ritesh.
Yeah. So Ritesh also used to teach the VC course at IIM Bangalore, and I was like,
right.
Yeah. All right. So so we'll start. What are we going to cover today? We're going to cover a bunch of things: modeling VC firm returns. But how does it actually track in VC firm? I'll try to make it interactive. I think the most important bit of this entire slide is the power law in VC firms. And if you forget everything else, that is the one thing you should remember. That is the secret, that is the code that of VC essentially, which if I had known probably 9 years ago, I would have been a much better investor today, right? And it took me probably 3 to 4 years to understand that. And then, some of the other things like understanding recycling, sector allocation, terminology. So quickly jumping in, modeling a VC firm returns. The problem statement which I had given, and I don't know how many of you tried it out, was develop a model for a VC fund for 4x return in 10 years, 4x gross return. And the idea behind the 4x is that for a top tier VC fund, that is the kind of return you need to target. Gross return, net would be 3x. But the most successful and best VC firms return much, much higher than that, right? So, but if you can consistently deliver 4x or more, you are a top tier great VC fund. Right? This and I have liberally used a lot of material which is available on the net. A lot of smart people have written about VC before me, so I'm not going to, it's a productivity hack. People are smarter than me. Just reuse their material, and you will find everywhere the references below, so you can click on the links and go to those. So, when we model a VC fund, essentially there are a bunch of things. Let me walk you through this, and please feel free to ask any questions, as and when you want. So, and I'm unable to look at the list of participants. So, Anand, Mohit, you guys will have to prompt if anybody wants to ask questions, or in the chat if they're sending questions. So request you to help with that.
Yeah, yeah.
Yeah.
Sure.
So yeah, so this is a VC fund model for $100 million fund. Most VC funds tend to have a 10+1+1 kind of a structure, which that basically means is life is 10 years, and then with LP agreements you can extend another 1 and 1 years, and that varies across geographies, across the kind of fund you are, and also across whether you're a new fund or an old fund. So let me explain what that means. So if you go to a geography like US, you will probably find funds which are slightly smaller in size, slightly smaller with exit horizons. So instead of a 10+1+1, you might just find only a 8+1+1 or 7+1+1+1, those kind of funds. In China, for example, specifically in China, where new funds were arranged in the last 6 to 7 years, you will find funds typically have exit horizons smaller. And the logic therein, which is applied, is that, hey, it's easier to go IPO quickly here. Companies scale much faster here. And generally, though, it is a new fund manager typically has harder time in negotiating with LPs for a longer exit horizon, and that's why you have smaller fund life. But having said that, assuming a standard 10+1+1 kind of a fund size, this is how the maths would look like for a gross return of 3.8 or a net return multiple of 3.1x, essentially with a 20% IRR, right? So what are the key things here? So I think one key thing here is the average deployment pace. And what you will observe is, so we deployed nearly 20% in the first couple of years, and then they deploy another 15 and 16% in the next 2 years. So that's roughly a 71% or 75% deployment over the first 4 years. So this fund is essentially saying that their fund lifecycle deployment is 4 years, and you will see, depending on the market conditions, or depending on how disciplined the investors are, you will see that this changes. This can be 50 or 60% deployment in the first 2 years, and then so the pace varies essentially. The second one is, obviously, once you're deploying, how much are you getting back? And that's the second line. So average proceeds from exits. Again, this varies geography by geography, strategy by strategy. Capital called is very simple, straightforward. So it's a $100 million fund. We are deploying 19.4% of the fund first year. So capital called is 19.4 million, as you can see there. And then the gross proceeds line is basically when you're getting an exit, how much of the exit you're getting. So that's basically 0 million for first year. The second year 2 is 0.1%, and it's rounded off, so you will get that number. Management fees of 2 million. So this fund assumes a 2 and 20 kind of a structure. So you will have 2 million as 2% management fees, and you are seeing it across the board. The interesting thing is, in year 11 and year 12, you will see there is no management fees, right? And that's why this is a 10+1+1 kind of year, where in the last 2 years, you might not be able to draw management fees. And then funds become more complex. Top tier funds might be able to get fees over at that point of time, or they might have a higher number of years of extension, etc., right? And then you have carry, which will be a 20% carry. The interesting thing to note here is that the carry starts off only once the hurdle rate has been met, or you have returned essentially the entire amount of money, right? So that's what you will see basically happening here, right? So this is a slightly sophisticated model of a VC fund, and the discussion I wanted to have and question I wanted to ask with people was essentially, what's wrong with this model, right? There are a lot of smart people here. Just wanted to check with folks, what is wrong with this. Anybody want to take a shot?
Hi, Prayank, Shubhro here. So one question is, and I don't know if this is wrong or right, but it's a question which is, assuming that, let's say it's a $100 million fund, and you have set aside 50 million for primary deployment and 50 million for follow-ons. and assuming that you're investing primary for the first 3 years and follow-ons for the next 3, shouldn't the pace of deployment be more or less the same, at least in the first 6 or 7 years, given that
No, it will not be. It will not be for the simple reason that in the first few years, people tend to see you back your winners, right? So you invest, let's say, in 20, 30 companies in the first. So out of those, in the first 2, 3 years, out of those, you will do second and third rounds in the year 2 and year 3. So you'll see typically year 2, year 3 paces tend to be slightly faster, and then year 4, 5, and 6, you are not investing in all the companies. You're investing in the few handful which have survived the first 3, 4 years, right? So it's a gradual slope down, basically.
Okay, understood.
Prayank, this is Harjas from Accel. Prayank, I think
you should know all this. Yes. kidding.
Okay, that's my comprehension test then. But okay, I think one thing that is wrong here is that we assume that we will not get any other funds during the cycle. For example, if we exit something in year 5 or 6, we can obviously use that money to deploy further.
Right. Yeah, that's right. So that is what is called recycling, and you will see that when you see the gross proceeds, and out of those gross proceeds, how much is actually distributed, the rest money can be again used in the deployment. So that is missing definitely from this. That's a good point. So recycling is one of the big things which is missing in this one. What else, guys? Look, imagine in your own funds, what is it that does not tally with the reality of this fund?
Capital call should happen. All the 100% capital call should happen in the first 3 years or 4 years, and not throughout the cycle of the fund.
No, Mohit, that is not right. So capital calls are spread over like this only. 100% capital call never happens the fund like this, right? So typically you will see capital calls are extended over a longer period of time. So by 6 to 7 years, you will see 100% capital call, but not in the first 3 years. So I think the confusion would be that when do you go out to raise a new fund? That is an agreement with your LPs as to at what level of cutoff you will have to raise a new fund. Is it 75% deployment, 80% deployment, 90% deployment, and the like?
Hey Prayank, this is Abhinandani from IFC. I think one thing that is wrong is that management fees over years tends to go down because the first 5 years, which is the investment period, it'll be 2%. But over time, because the fund is more in supervision mode, it'll decline.
Yeah. Anything else, guys?
Hi, Prayank.
Hi.
Yeah, Shashank, please go ahead.
Yeah, so I think there were 3, 4 things that I could see. One was that, of course, as Abhinandani mentioned, management fees tapering. Second is there's a lot of interest. If we call it earlier, then we can call interest. Third is that the exits don't happen.
Sorry, what is interest?
So, for example, if we have an early exit,
Hello.
Within the capital call, there's also the exit. I think Chirag also mentioned the same thing. Exits don't happen early on, but typically when I see exits, and if I see the successful companies in portfolios, they always happen at the end of it, because you want to hold on to it for a longer time period for a power law of returns.
Yeah.
So that would be the third point. And I think management.
See, management fees. Go ahead.
So last point. Fourth point was that management fees is so the management carry should also be typically taken at the end, only at the end of the life cycle.
Yeah, I think management carry has been taken here towards the end, so I don't think that's the problem.
Is the carry happening after the hurdle is paid back, or is it happening after the capital is paid back? It's happening after the
cap. So that is the good point, Anand. That is what is not shown here. So in this particular model, I have not checked, but that's a good point. So when is the cap? Is the hurdle rate met or pure capital return?
Yeah.
That is a good point.
It depends on the negotiation, of course.
Yes, that depends on the negotiation. So that is the other point to note, right? Guys, sorry, going back to the previous speaker, I think one quick thing is, if you see from the exits here, which are modeled here, you will see majority of exits are happening towards the end of the fund.
Yeah.
Right. So it is always backloaded, and the other part is the carry is also happening towards the end of the fund as you start getting the exit. Right. But I think the two big things, actually, of all these things, there are a couple of big things which I was hoping people will figure out. One is the deployment pace for this fund is actually extremely slow. So, all of us being in India, and actually the first two lines are the most important lines. Everything else is just an output in a way, right? So the first two lines, the average deployment pace, if you were in the VC industry in India in 2015 and 14, you will see that year one people were deploying 50% of the fund, and year two people were deploying like 30% of the fund, right? And the average proceeds from exits of those funds will probably happen in year 8, 9, and 10. So you will not, and especially in India, that is a problem where you will not see any year 2, 3, 4 kind of exits happening, because majority of the times the companies don't get sold for cash. They get sold for either stock in India till now, or they don't get sold very easily, right? So in India, the big problem is year 1 to year 5, typically people don't see any liquidity. And that's why in India, the big challenge which happens is your IRRs tend to come down. So that is one. There is a special problem with Indian VC funds. Indian VC funds, I mean, people who invest in India, including foreign VC funds as well as Indian rupee VC funds. Can anybody point out what that problem is? At the end of the day, the return has to be 3x or above. That's what we discussed. So what is the other special problem with Indian VC funds?
The dollar rupee rate.
Dollar rupee 10%.
Correct. So typically, most Indian VC funds see a dollar averaging or dollar dipping, and that's where the problem is. So if you look at last year, all the VC funds which raised VC money was at $70 INR, and then right now as we speak today, I think it is 76. So 10% has just declined because of that particular reason. Right? Having said that still, if you have a decent pace, you can still manage it, because if you're year one, you're only calling 20%, then only 20% is affected by the decline in rupee. Similarly, year two, so each year you will have, whenever you do a capital call, the dollar value at that capital call helps ensure that it's kind of matched out. But yes, people have to figure that part out significantly. Indian rupee denominated funds don't have that problem, because they raise money in Indian rupee and have to return money in Indian rupee. Anand, any view on that?
There is hardly any serious amount of money in India, Prayank. So I think we have to provide for a dollar adjusted rate. By and large, every fund aims to raise money overseas, right? We started raising money in India, but then the second fund, third fund onwards, a proportion of money from outside India increases, and that'll be true for everybody. So I think even otherwise, when you report, you have to state your Indian INR number also in dollars, right? So the rate effect will come in. I also feel that it's not that dollar is appreciating; it's rupee that is depreciating. So since dollar is a global currency, we better peg it to that, right? I mean, ideally, I'll peg the returns in terms of gold price. So that's a different point. So
yeah, and guys, this is the problem arises, right? So LP is going to give money. The first question, all LPs ask this question: why should I invest in India when anyways I'm going to see my IRRs decline because of this? Right? So all Indian managers actually have to target a IRR which is much higher than this 20% to be able to, just because the rupee is just depreciating, right? So, and that is where the challenge arises, right? The 20% IRR itself is quite high. Okay, so we have a bunch of slides. I'll try to walk them through quickly. So I think this is pretty straightforward. Again, I'm not reinventing any of the wheels. People have discussed this significantly. You can look at all the slides. Every slide has a reference. So this is basically what we said is a 3x return. So this is in this particular, the gentleman assumed a gross return of 3x instead of a gross return of 4x. So $200 million fund, which has to return 3x, has to do 600 million returns. He's assumed a 20% equity on the at end across the portfolio. So you need to generate $3 billion of exit, right? Now, like I said, there are two fundamental problems, right? So one is the 3x, and the second big problem, and this is the equity ownership, which is 20%. As you would know, majority of funds are unable to manage a 20% equity unless until you are like $1 billion or $500 million kind of a fund and you participate in multiple stages of the company, right? And this particular problem accentuates if you are a bigger VC firm. So if you're taken out $1 billion and you have to return then 3 billion and you own 20% equity, then you have to return $15 billion. Assuming that majority of VC funds own 15%, you'll have to return close to $20 billion. And today, if you look across all the, I think at least a couple of years ago, it used to be true that all the unicorns of India combined would be close to 30 billion. I think that number probably now closer to 50 billion, right? Which basically means if you have a $1 billion fund, then you better have roughly 50% of the unicorns in your portfolio in India. And this becomes slightly easier though in other geographies where the number of companies is just larger and the unicorn pool is bigger. So, but if you are raising more money, obviously with great money comes great responsibility. I think that holds true in VC firm as well. Any views by anybody on this? Any questions?
So the number of unicorns, this is Anag from Stellaris. So number of unicorns or the unicorn pool as such, there's always a fast future look, right? That from 7 to 10 years from now, how many new unicorns I would want to create, or how many new unicorns are expected in India. So I guess that is what we pitch to LPs when we try to get funds from foreign investors.
Sorry, I could not hear you properly. Maybe my internet connection is bad. Just 1 second.
Yep. So my point was, hello?
Yeah, go ahead.
So my point was when we pitch raising a fund to foreign LPs, do we not always focus on a forward-looking view that right now, let's say we have only say a $30 billion unicorn pool, but this is poised to go to $100 or $150 billion by the time our exits will be happening?
I think so. So obviously that is the sales pitch by all VCs when they raise money. I think the question is not that. What the LPs are looking at is, do you have the wherewithal and experience to be able to show that you have the track record, obviously, which was always the best, that you can pick the right winners, right? So if you're going in thesis when you're raising a $1 billion fund, is that you're going to be able to get 50% of all unicorns that are going to happen. And mind you, this is like, you can say the pace is increasing, and even then that number would come to only 15-20%, right?
Yeah.
15-20%, that's not a trivial number to be able to get, right? So when I started in the business, I think we probably had 30 odd VC firms in India. Now we have more than 100, right?
Yeah.
So as in the VC industry, also the number of the competition is also increasing. It's not decreasing, right?
Mm-hmm.
So, right. So that is the challenge, right? So every LP would come and ask you, why are you better than another fund? Why should I invest in multiple funds in India?
Got it.
Yeah. So moving on. So what we just discussed, what are the factors that affect fund returns? So ownership is probably the single largest, key determining factor, and that's why you will see people fighting it out. And then the biggest problem most VCs have is the price increasing, is the price decreasing, and that's what people worry about all the time. That earlier I used to get 30% for $1 million, and that's probably what we did for. So when Accel invested in Flipkart, that's what we owned. We probably owned 30% of Flipkart for 800K, right? And today at 800K, it's like a pre-seed or seed round, and you won't get much. So there are some questions.
So Prayank,
Yeah.
if every fund has to, Anand Dunya here, if every fund has to return like $5-10 billion worth of unicorns, right? Do you think that there will be enough unicorns in the country?
So Anand, your question has two parts. So one is, I don't think every fund has to return that many unicorns for sure. Right,
Yeah.
a smaller fund, for example, doesn't need to return that much. Right, so
Yeah.
if you go back, a $200 million fund based on this has to return 3 billion exits.
Right.
And I think depends also the LPs which you get. Right, so for example, at Accel we want to get more than 4x gross. Right, so whenever we target that, then we have to obviously have a higher bar. But a smaller fund needs to return much less, right? So, and they can work out with less than, so one or two unicorns in a portfolio of a $200 million fund will be more than enough. Right? So if you look at Accel's fund 2, which was 150 million, which was actually a $60 million fund, we ended up with Flipkart, right?
Yeah.
So that returned the fund many times over.
Yeah, yeah.
So I don't
But
think.
still, you will still need one or two unicorns in a $200 million fund, right?
Yeah, I'll come to that. So we'll walk through that. There's a portfolio construction discussion happening on it.
All right. Okay. Cool.
The second is, I think, the exit pace. It helps in two ways. If you can get money out quickly, you can reinvest, like Harjas had mentioned, and allows you to then pump up your IRRs. And LPs also get happy with it because they get distributions faster. But majorly, if you can go quick early exits, then you can repeat. Like I think one of the fastest exits that I've seen was I think Andreessen invested in one of the companies Microsoft had bought, Skype, and within their investment 2 years, within two years investing, Microsoft bought it for $8.5 billion. Right? That was probably one of the large exits which happened very quickly in a very short period of time, and you guys will see what happens with that. So in the real world, so some points in the real, so this was all theoretical maths, and we discussed slightly in the air. In the real world, there is some return persistence in VCs, right? So this is a study done by CFA guys. I'm assuming a lot of the people over here would know about this material, but the top quartile of VC funds generally tend to outperform the bottom, like they stay, like the top quartile funds always stay in the top quartile. I wanted to get a sense from people if they could think why this happens, right? Why do these returns persist? Like, why are these funds performing better and better or consistently better?
So bro, here one of the reasons would be because you're a top quartile fund, the best deals always go to you.
That's right.
I think the second point would be that the large funds where probably a lot of secondary exits are happening, because they are having lean teams, they largely tend to look at signs from investing from top funds, and they invest in these companies.
So I don't agree with that. The reason for that is because this has not happened in India yet. I mean, there are some signs of it, but at least in US and China, a lot of new VC funds have been able to break into the ranks of top VC funds, right? I think so. That is not true. I mean, I think unique points of view or contrarian points of view funds who have that have been able to show that they become top VC firms quickly. Right? If you look at even Andreessen Horowitz, I think 2009 was their first fund which had come out, and so it has been fairly recent, right? So, and a lot of other funds have come out. So that's probably not. I think that's a myth that the top VC funds dictate what is going to happen. Yeah. Any other points of view?
Yeah, also probably from a fundraising point of view, the better performing funds are always able to raise larger funds, and hence they are able to control more equity in their winners.
That's right. So that is a very, very strong point. I think top VC funds, definitely a larger fund allows them to participate in seed, Series A, Series B, Series C, all the and maintain equity for a longer time, and that has a significant impact on the final outcomes. Okay, so and I think this one chart also talks about what Ritesh mentioned and all the points which you guys mentioned. lead to that network effect kind of a theory where top VC funds have more money and have more winners, which attracts, which improves their track record as well as improves, allows them to attract more and more better companies to come to them. So they are able to choose between that, right? Having said that, I've also seen a lot of new VC funds who've been able to break that into that by just working harder, right? So you have proprietary deal flow, you make up your networks, you build out and find out the best, smartest guys who will create those companies, and you go and put money into them early, and then you can become a top tier VC fund, right? Now, it is very hard to get VC fund performance of any publicly available. This is a publicly available VC fund information of Andreessen Horowitz. So as you can see, they raised their first fund of 300 million in 2009. Then 2010, they raised the second fund. So they have maintained a 2-year cycle of raising funds. And their first year fund was essentially a extremely high IRR fund of 44%. And I think, like I mentioned, that was probably done because of the Skype exit. I'm not privy to all their investments. I think an Airbnb was also sitting there, but I don't think Airbnb they would have exited too much money. But that gives you some sense that this is and this is considered one of the top tier VC funds, right? And they are. So if you look, they are part of a lot of companies, right? But what you see here is their own IRRs have declined, right? And forget the last one. We will talk about generally in the first couple of 2-3 years, you will always see negative IRRs in a VC fund. But fund two, for example, so the drop from 44% to 16% IRR is a significant drop, right? And would anybody want to hazard a guess why would this drop happen? Like, what are the common reasons why? People haven't changed. Their strategy didn't change really between at least those two funds. So what happened because of which the IRR started falling?
Fund size increase.
तो बहुत early portfolio है ना? This is very early, right? So I don't think that it has played out yet.
Nee, but Anand, even the fund two was 2010, so 10 साल हो गए.
Yeah. No, I agree. I think it's size increase is one big reason, and second is that
let the analyst take a guess.
Yeah.
Prayank, this is Pranay from Accel. Could be because they might have deployed it. They did all the capital calls really early on, so that reduces the IRR by default.
No. उससे इतना फर्क नहीं पड़ेगा.
Prayank, Shubhro here, just taking a guess. Maybe in 2009 in Fund 1, this was right after the financial crisis, so the valuations were lesser.
Yes,
very random.
That's a very strong point. Very good point. So valuations were less, and as you can see, probably today is the right time to invest because whatever is happening. So 2009 and now 2020. So that is one very strong reason why this fund would have done well. And second, and to Pranay's point, just because you have a lot of capital calls early on, that does not matter because as long as your company scale very fast and grow faster, and given they had a larger fund, I would have assumed their IRR could have been better, right? Because they would have then been able to do multiple rounds. But then I think a very big factor which plays out in VC firms is competition, right? So prices are cheaper, and you do when competition increases and you have this FOMO that everybody else is investing, we are not investing, we should do more investments. Then you basically end up doing a lot of bad deals, right? That also brings down your fund performance. Any other observations, guys?
Just a follow-up question on what Shubhro said. So see, we dropped from like A16s, we dropped from 44 to 16, and then it's constantly around that 10 to 16% area. So how much of that could be attributed to the 2008 financial crisis is something that I was wondering.
Well, so if you will look, and this is my hypothesis, and Anand, Ritesh, please join in. my viewpoint is majority of the times whenever there is a significant crisis in the financial markets, that's the time you end up with a very large outcome in the VC industry. Like that particular cohort of funds generate a lot of value. Always, right? The future funds, the price is just increasing, right? So I think we saw a couple of SaaS companies getting funded last year at like between 30 to 50 times of forward revenues, which was crazy, right? So and if you're a SaaS investor, your returns on that, like to justify that kind of a multiple, the company needs to become a 10, $20 billion company if you're investing in the early stage. So I think that's the other, so competition and price and your holdings, and which is basically a factor of what price you're getting in at, are play a very important role. And then we are going to talk a little bit more about portfolio construction in the future. So till now we're talking macro level. We talk about specific portfolio level also, right? But there's one more reason why fund performance decrease. Anybody else wants to take a guess?
Hi Prayank, this is Pushpak here from Pravega. Couple of points just quickly flagging off. So this sheet is as of September 30th, 2018. But if we see something like Lyft was an exit just last year, which would have probably been Fund 2 or Fund 3 and would have significantly bumped up the IRR on those. So I think the broader commentary around companies staying private longer, liquidity events being pushed out further into the future, may mean even 2010 may not be fully reflective of potential sort of final IRR.
See, the interesting bit here is the IRRs are decided by how do you decide a fund's IRR, right? So it's mark to market, right? Depends, and actually that thing differs from fund to fund. By the way, Andreessen actually got a lot of beating because of this particular chart, and they actually posted a whole rebuttal for this piece on their blog. So it's an interesting read as well. So how do you calculate IRRs is also very important, and that is a good point. So the exit of Lyft would not, I mean, you should look at Fund 1 and Fund 2, right? Exit of Lyft, basically what your argument is, in the Fund 2, there a bunch of companies would have marked up significantly more, and because of which the Fund 2 IRRs would have increased, right? So I'm not privy to what the Fund 2 companies were, but given the fact that this was done in 2018, majority of companies would have gone through a significant inflection on the price. So for the 16% IRR to go closer to 44%, I think it's highly unlikely. Therefore, the companies would have to grow like 5 times in 2-3 years to be able to meet that kind of IRR. So we discussed a bunch of these things. So just moving forward, and please read the blog. It's very interesting how they rebut this article, which was written in New York Times, in Wall Street Journal. So competition in the market, we discussed this. Fund size is increased, though it allows you to invest across stages, but it forces you to also do more deals. And if you're not careful of doing deals and you get into FOMO, then you end up getting screwed. Team split. I think this is very important. This happened in China significantly, and there have been some examples of this in India. Successful VC firms, 1 or 2 successful investors in the VC firm basically come out of that VC fund and start their own funds. And this has, so VC fund is a lot of individual driven sport as well. It's a team sport plus an individual driven. So there are some investors who,
I think an additional thing to team split is that even if the teams remain intact, the number of investments in the team doesn't necessarily scale, isn't it? Even if the teams remain intact, the performance may not scale.
Yeah, so that's a good point. So assume you have an investor, which is an early stage investor who was investing from a $50 to $100 million fund. And let's say their second fund was a $500 million fund. So they did exceptionally well in the early stage, and they went on to raise a $500 million fund. Now that brings in a problem because the person knows how to invest in pre-seed, seed, and Series A. How do you make sure that he also knows to continue to invest in Series C and Series D kind of deployments, right? And that's why 3 and 4 kind of go hand in hand. You raise more funds, you are forced to put more money in Series C and Series D as well, right? So you put $1 million in your company in seed, but when you are participating for pro rata in a 50 million round where you own 20% of the company because you own that much in Series C, you have to put $10 million. So, and as you go higher in seeds, your return profile on the later dollars reduces.
Prayank, I had a question. If the team split, let's say before the fund 2, And if the performance is not up to the mark, how is the fund has been able to raise so many funds consecutively? Because of the team split, or it's been continuously
No,
just
I'm not
splitting?
saying Andreessen Horowitz ka team split hua hai. I'm not saying that.
Oh, okay.
Yeah. I'm not saying that. I am not aware whether their team split or not. This is not a commentary on.
Oh, okay.
I was just giving example of Andreessen. But there have been cases, for example, in China, I know of funds where the fund is doing exceptionally well, and there are 2-3 star performers, and basically they say, hey, we can do quite well, so they just go launch their own fund separately, and they continue to do well, right? And now that particular fund, which had, let's say, 4 fund managers, has one less, and let's say that one person was doing all the crazy deals which were generating returns. So what will happen to that fund? So by no way this is a thing on Andreessen Horowitz. It's just a rhetorical question. Why will it decrease?
Yeah, this is Ritesh. I'd like to add a couple of things here.
Yeah.
Actually, it's a relatively persistent phenomenon of first funds doing better than later funds. And one of the conjectures there is that you need one great company in a fund 1, whereas typically in a fund 3, fund 4 and beyond, you need multiple great companies in the same fund. So just the size of the fund and the fact that it's a first fund both have a high correlation with high returns. Another thing that I've observed, though I don't have any data for it, is that as a fund's team becomes larger, even if it doesn't split, what happens in larger companies also starts to affect larger funds. So processes become more bureaucratic, people are incentivized to take lesser risk. And then there is a return to a mean in a way, so what I think you were calling the ability to do crazy deals, that actually goes down as fund teams become larger and processes rather than intuitions start to rule decision making.
Yeah, I think that's a very valid point. As your IC becomes bigger and bigger, people start to formalize a lot more processes. Kecha investment on likhenge, have you done modeling properly? Have you done 15 customer calls or not? Because it's a directive checklist for everybody so that everybody is on a standardized DD, and that sometimes blunts the edge. Right. So I think every few years, or at least in Accel, we try to reinvent ourselves every couple of quarters and say what is going wrong, what is not going wrong, and it is definitely not an easy job. Thanks, Ritesh, for that. So moving forward, I think this is the most important topic in this whole presentation, and Ritesh and Anand, please feel free to jump in and join in whenever you can. You guys are more experienced than me on this. So, what are the power law and VC returns? The power law and VC returns basically says 2 things. A small percentage of firms capture a large percentage of industry returns, right? And a small percentage of portfolio companies will return large portions of returns for a VC firm. So point 1 is alluding to the fact that a few VC firms in the industry will capture majority of the profits or returns. And the second one is within those VC firms itself, a small percentage of portfolio companies will return large portions of returns for the VC firm. And let's look into that, right? So this is a very interesting analysis done by AngelList. AngelList guy said if you were given enough money so that you invested in all possible, so you could do a theoretical exercise where you say, let me make all possible portfolio combinations of all possible investments available on AngelList, then what will be my returns look like, right? So what you see on the x-axis are investment returns, and what is the relative frequency of those returns. And that line which you see, the black line, is a line where if you were to write an equal size check to all the AngelList investments, you would have got that much return. So it's, I think, probably 1.6x. So if you blindly just wrote everything which AngelList gave you, an equal size like 1 lakh rupees or $100 in each of them, you would have gotten a 1.6x. What you see, this is a fat tail. This is a the tail of this distribution, of this probability distribution, is extremely long. It's a long tail event, right? So 5x, 4x, and the tail is very different, right? It's not fat tail, right? It's actually very thin and it's very long, right? So there are exceptional. What this tells you essentially is that occurrence of 5x, 4x, 3x is very rare, and very few portfolios will be able to match that kind of a number. Occurrence of 2x or below is quite common, and that holds true even for VC firms. So what I'm trying to come back from this is, if you were to find that 4x problem which I framed for you, that is what all LPs want, what all VCs want, but very few are able to achieve it. And let's look at this with some example. And thanks, Ritesh, for pointing this out. So Horsley Bridge, who's a very big LP in a lot of funds in India as well, they came out with this data, and they are LP in Andreessen Horowitz, and Andreessen Horowitz basically published this. So if I were to read this, they basically looked at all the funds which had been raised till 2000, and I think it was 18 from 2016, sorry, all the way from 1984. And you will see deal distribution by share of funds. So if you look at funds which are 1x, how many of their deals were deals where they lost money? How many of their deals were where they made 1 to 2x? How many of their deals were where they made 5 to 10x? And how many of their deals were more than 10x? Kind of 2 to 5x and 10x. The interesting bit here, I think, is these two slides, these two bar graphs. So if you were to look at 3x to 5x and 5x funds, you will see the distribution between where they lost money and where they made money. That shift is not very significant. But when you go towards how much money they have made, share of fund returns, you will see the 5x funds get disproportionately large amount of money from their 10x or greater deals, right? So basically the idea there is this.
Yeah, actually what it says also is that funds which are more than 5x, they have more write-offs, right? The write-off portion is actually higher.
That's also a good point. Yeah.
It's slightly higher than the others, right?
Yeah.
They take more risk, basically.
They take more risk. That's right. And we will talk about this also in the future. And interestingly, if you go deeper into the, so what essentially we are saying is more than 10x deals return majority of returns for the 5x funds, right? Now, if you go in further, so there are no 10x deals. Essentially, when a deal is doing more than 10x, those deals actually return 64 times money. So if you look at this fund, the 5x greater than 5x fund, so the gross return for that particular fund, those funds was 13.7 times. And if you look at the gross return of the 10x deals inside those funds, it was 64x. So, and what this says is across all the funds, 10x deals return 43 times the money, right? So in VC, your very successful deals will return disproportionately high amount of capital. So when very early on, analysts and associates and when I joined as an associate, I was also like, hey, why are this company is profitable, sure shot, we will be probably able to make a $300 million exit out of this company, we should invest. Why are we trying to go after a couple of $1 billion companies? And this is the reason for that you need extremely high, large outcomes to come out of your winners. And since nobody knows which is the winner, you'll have to bet that every company has to be very large, right? So now the same thing is explained. I'll just walk through very quickly. On small portfolio of companies will return large portions of returns VC firms, right? So this is a problem. 10 startups. So I'll just read this problem very quickly. So we have a $100 million fund, which is going to invest in 10 startups. We want to return 3x within 10 years. And we have invested $10 million in each company, right? So we want to return $300 million, right? So that is what we want to do. A $100 million fund trying to return $300 million through 10 companies over 10 years. And we own 25%. We are assuming that till the end of the fund, we own 25% in all of these companies. So this is one model where we invest across all these companies, $10 million, and then we exit all of them at 50 million. So this is one way to model this. Let's say all the companies were done, right? So we will end up with $125 million. So the way to read this is $50 million का exit हुआ, you own 20%, or so you own 25%, so you get $12.5 million at exit. So what you have generated is 12.5 million into 10, right? So this is way short of what we want. We want 300 million. Now let's say we change the problem a little bit. So 5 of our companies sold for $50 million, and another 5 of the companies went for $100 million exits. So you will end up with 187.5 million. It still does not solve our problem. Then let's say majority of the companies sell for the same, 50 million. So we make, in the previous one, 5 companies sell for 50 million, 4 companies sell for 100 million, but 1 company ends up selling for 500 million, right? Now in this case, we end up reaching at $287.5 million. It's very close to what we want, but still not there. And this is where, things change. So if you get $1 billion exit, right? So you have 9 companies which got sold at 50 million, and you had $1 billion exit, you ended up with 362.5, right? This is the reason you want a unicorn exit, right? However, the world does not work in this fashion. So the world will probably work like this, where out of the 10 companies, 5 companies will fail. So you'll get 0 million. You'll have 3 companies which will exit at 25 million, not at 50 million, right? So you will get 25 into, you'll get 6 million from them. So $18 million out. You'll have 1 company which will exit at $200 million, and then you'll have 1 company which will exit at $1 billion. Right? So that's your $318 million return, which is coming to you, right? The super big assumption here, right? So the question I have to ask for you guys is, what is wrong in this model?
So Prayank, Chirag here.
Yeah.
Couple of things. Actually, we can't deploy the entire 100 million. Part of it will be management fees, fund expenses. That'll roughly take away 15-20% of the overall pool. Second, obviously, for $1 billion company, having 25% stake is not realistic, even if it's a staggered exit.
Yeah.
Right. So around 15-20% is an optimistic scenario. So I could see these 2 things at least primarily.
Yeah, those 2 are actually extremely right. So I mean, out of the 100 million, 20% is anyways going to go into your management fee. So you have actually $80 million, right? And then what if that $10 million which you're going to invest initially in the $1 billion company you didn't have, and you missed it? You will not have that $1 billion exit anyways. The interesting bit here is that majority of VCs in their first 10 to 11 years will end up investing in 10 companies. So you will end up doing 1 investment per year, or probably 1.5. So you'll end up with 10 to 15 companies what you'll invest. So this portfolio is, even though it's reflective of a $100 million fund, it's also reflective of an individual VC. So this is the performance graph. So you will always have a few declines, you will have a few mediocre outcomes, and hopefully you will have a large outcome. And if you don't get that $1 billion outcome, essentially, you will not, it's just going to be very hard to justify that why you're a good investor. And it takes a long time to realize this. So, and this is, I think this is near realistic. And like Chirag said, a majority of the time we end up owning, majority of people own anywhere between 10 to 15%, not 25% of the company. So this is quite hard. And in that particular scenario, this particular VC would have owned, let's say 15%. He would have made 100 million less. So he would have made $218 million. This is quite hard. So what are the implications, right, of this? And I'll, you want to jump in, Ritesh? I'll hand over to you. But Ritesh, you want to jump in?
Yeah, absolutely. Please do remove sharing so I can share my screen.
Yeah. Can you start from this slide, slide 28?
Actually, then why don't you cover this one, and then I'll take over from after that.
Okay. So what are the implications? There's a bunch of questions, how many investments should you do in a fund? Right, and all GPs sit down and discuss this when you raise a fund. How many should we do? How much should you own in the beginning, right? The first, and when should you enter, right? Should I enter in seed? Should I enter in Series A? Should I go in very early? And some of these are questions relevant to larger VC funds, whereas smaller VC funds know that they have to enter only at seed or pre-seed. But larger VC funds who can enter multi-stage funds have to decide that. How do you decide reserves, right? So in the previous scenario, we had 10 out of the 10 companies, 5 failed. If you were to keep on investing across the board at the same level, then you won't have a scenario where you are not able to invest more money in one particular company, right? Which of the companies to double down on, right? So you invest in the year one, by year two, some of the companies will start to grow. And then you'll invest in year two, and those companies will take time to grow in year three, right? So, but in year two, you have to make a decision how much money to invest more in year one companies. And that is where the challenge lies, right? So how do you decide on that, right? And then even then there are, and historically you would have seen in India, and now you're seeing at a global stage, are your short winners short, right? So look at what has happened in some of the large multi-billion-dollar unicorns in India as well as globally. WeWork, for example, right? People would assume that is going to definitely list. People, but what happens now, right? So those are not short winners. And historically, also in India, multiple companies have failed in the past, which were billion plus, and now they don't exist anymore. And what about black swan events, right? And I think, like for example, COVID right now, right? So you have a company, let's say, which is a couple of billion or more. Things were going fine. They were able to raise a lot of capital, and they were burning, let's say, $50-60 million a month, or maybe even $20 million a month, a lot of money. And suddenly COVID hit, revenue is zero. Now what do you do, right? So there's a lot of things which, and interestingly, these black swan events happen very frequently. So I don't know whether to call them black swan or not, right? But they do happen very frequently. Not at the scale of COVID, but regularly they do happen. And I think Ritesh will take you deeper into some of these. So let me pass it on to Ritesh. Yeah, Ritesh.
Thanks, Prayank. Just give me a second to project my slides. Let me just project the screen. Can you see my screen?
Yep.
I'm assuming you can see in full screen, right?
Yeah.
Great. So what I wanted to do was to try and give a few practical considerations of decisions that need to be made based on the models that Prayank introduced. And the first one, I think what Prayank also mentioned, is what I call portfolio triage. Now, I'll start with some examples of how portfolio constructions have gone wrong. In one of the previous funds that I was associated with, we made the mistake of being too democratic while allocating capital. So that had two implications. One, we actually lost a lot of money in companies that we had invested large sums in, and that did not do well. But a larger and probably a more criminal fact was that we did not have enough money to back our winners. We actually ended up having less equity in our winners than we had originally planned to. And that was actually, to me, the number one cause for that particular fund not working out. Let me try and explain this graph here. It's a little complicated. This is assuming that your winners generate the same return, your money back companies generate the same return, and your loss-making companies generate the same return in all three cases. Also, the number of those companies is constant. So in this particular case, I've made a very generous assumption that 20% of your portfolio companies are winners. They generate, I think, some 8.5x. That was to artificially get to a number of 3x for the fund. What happens when you allocate differently? So case one is equal allocation. You give every company in the portfolio the same amount of money. And for a portfolio like that, you then generate a 2x. Case 2 is when you are able to identify the losers, but you're not able to identify the winners. This is, so what you do is you put a certain amount of money equally in all companies. And in the next round, you double down on some companies early. But after that, for the remaining companies, you give them equal amounts of money, which means that you still can't identify who your 2 out of 10 winners are, but you have identified which are your 5 out of 10 losers. And the third scenario is when you're able to identify both losers and winners, and you participate in 3 different rounds. In the first round, you invest in everyone. In the second round, you invest in companies which are not going to be losers. And in the third round, you invest in companies that are only going to be winners. Now, with the exact same returns from each company, look at how huge a difference does capital allocation make. In the first case, you end up with a 2x fund, even though you had 20% of your companies as large winners, which is almost a dream scenario. This is not a usual scenario. Whereas if you are able to correctly identify both winners and losers, your returns shoot up by almost 4x of what they would have been. And this is, so first I just wanted to exemplify what the impact is of good capital allocation. But it is very easy to say, and it is very, very hard to do in practice, good capital allocation. It requires, in my mind, 2 different things. It requires very high intellectual honesty on behalf of the investment team that is involved with a particular investment. And when I say intellectual honesty, I don't just mean I don't just mean honesty in terms of the day-to-day honesty of not being truthful and being able to communicate everything there is to communicate about the company, but also in your own mind, clearly teasing out the reasons for success or failure, or even knowing whether a particular company is on a path to success or failure. Because nobody else can judge that but you. There is always, in every case, even when companies have failed miserably, there is always an excuse, there's always a justification as to why it was a completely chance effect, and that by putting a little bit more money into the company, you can turn it around. But the only person who really knows whether it is good money after bad is the person who is actually managing that investment. So one, it is a test of the individual investor's intellectual honesty. Second, I think it's a test of a firm's decision-making process. Most often I find that firms are democratic in allocating capital when there is decision by consensus, or when there is or when people are walking on eggshells around each other and trying not to hurt each other by being critical of each other's portfolio companies. So to me, actually, portfolio triage is the true test of a firm's decision-making process. At every stage, are you able to make it incrementally harder to take that decision? Which is why some firms actually process-wise make it harder to take every incremental decision. So sometimes you'll see that a single partner can actually write the first check in a company, but more support is required to write a second check, and even more support is required to write a third check. So there is no one right decision-making framework, but it is very important that individually, I think all investment managers are actually intellectually honest about the prospects of the companies they are involved in, and collectively the firm has a process that allows them to cull certain companies and allocate more capital to the winner companies. Also wanted to point out that this is a game of escalating costs, that the cost of making mistakes keeps increasing every time you write a new check, which means that the strategy that actually makes most sense is to be very aggressive at entry, but be conservative with follow-ons. Because if you think about if you think about a typical portfolio construction, let's take this portfolio construction, the middle one. You are allocating 25% of your capital totally to losing companies, which means I have to do the math. I did it for $100 million fund, but for $100 million fund, the total capital you deploy in each company at the beginning is $2 million in this particular case too. And in case 3 it becomes even less. In case 3 it becomes 1/3 of 80 roughly $1.25 million only in a $100 million fund.
Ritesh, I have a point.
Sure.
Ritesh, you can also make a mistake of wrongly identifying winners. I mean, for example, you invested in WeWork because SoftBank is coming, for example, like what Prayank was talking about earlier. And if you over allocated instead of your average equal allocation strategy, over allocated on the wrong company, then your returns could actually go lower than 2x, isn't it?
Yeah, of course. So actually, that is approximately what I mean by be conservative and follow on. That initially making a mistake will not cost you that much. But because you have limited capital, especially for later rounds, putting that capital behind a company that ends up not being that winner has 2 issues. One, you end up writing off that capital, but in reality, you are writing off multiple X of that capital because you are not able to give that capital to another company that does end up becoming a winner. So if we think of a 3X fund, for example, every time we make an allocation, we actually don't think of it as a 1X allocation. Let's say we are putting in a follow-on round, we are putting in $5 million. We are actually not investing $5 million. We are investing for a 3X fund, $15 million of our returns are going to a company, which means that that money is not going to be able to generate $15 million from your returns. So my point is that it is a little important to be conservative in follow-on investments and have the right processes. Now, of course, there are times where you end up losing money in follow-on investments as well. And I just want to give an example of a mistake I made early on in my career, which is similar to what Anand was referring to. I'll not name the company, but there was a company that I was not sure was doing well. I had some concerns on the business model, some concerns in the execution capability of the team, and so on and so forth. And it was still in a wait and watch mode as far as I was concerned. A very large investor came in and gave them a Series B term sheet. In those days, $10 million was a very large amount of money. They gave a $10 million term sheet. I was quite surprised. I was even more surprised when a couple of weeks later, they received an even larger term sheet from another large investor. And that is where I think I made my one of the biggest mistakes of my career. When I decided to suspend my own conviction and support the company because otherwise they would not have been able to consummate that term sheet. And the logic was that if these 2 large and great investors are fighting over this deal, it must be a good company, and maybe there's something wrong with my own assessment of the company. Needless to say, we lost not only the money we had put in till Series A, we lost the money in Series B as well in that company. And I learned a very valuable lesson there, which is to not borrow conviction from anyone. If you know more about that company than other people do, then it is better not to base your decision on other people's conviction. But that's just one example of the kind of mistake that can creep in following on. It is hard to avoid all mistakes, but I think raising the bar for follow-on investments is actually a very good idea while making follow-on decisions, because you have to at that point starve Peter to feed Paul in a way. I do also want to make another very small point that that this 7.5x return with the same portfolio returns is actually more of a mirage, because there is a significant trade-off between breadth and multiple. So here I have assumed that the multiple remains the same. The multiple you make in the winner remains the same, whether you allocate in the first case, sorry, the number is not there, 10% capital to it or 43% capital to it. But the fact is, the more capital you allocate to a company, actually the lower the return, assuming that the exit size remains the same. So in reality, even the perfect allocation in that kind of a scenario will lead to maybe a 4-5x kind of a fund return and not a higher fund return than that. Anyway, so questions on this before we move to other key topics apart from portfolio triage?
Hi, I'm Shashank. May I go ahead and ask the question?
Yeah, please.
Hi, Ritesh. Shashank this side. One question on more softer aspects of follow-on. So let's say we are a seed investor and we, there's an external investor who wants to invest in Series A, but we don't have that conviction. Now, the one option is to not invest, but then it also gives signaling on the signaling side. It gives a bad signal to the follow-on investor, and he may also have cold feet. Which again means that if our investment was to become 3-4x on a short-term basis, we are letting that go. Plus, on the founder side as well, founders are our main people, our main consumers, as you mentioned in the first meeting. Now we are not being supportive to that founder whom we showed conviction in the first round. So how do we, do those things specifically from a capital allocation perspective?
It's a very good question, Shashank. I don't have a very good answer. I actually later in this one, I have identified this as one of the main conflicts. Just look at the last point here, main conflict between the fund and the firm. So when you care about your firm reputation, you are necessarily making a trade-off between your reputation as a GP and the returns to your LPs. In the ideal scenario, you won't have to make that trade-off. However, if you take a slightly longer term view, so I can't tell you what's the perfect answer. I can tell you how I think about this, which allows me to sleep at night as well. If there is capital that I have already committed, I would not go back on that no matter what. So let's say you have committed a tranche and you realize in the middle that the company is not doing as well, and you have the temptation to hold back the tranche. I would strongly suggest do not do that. Even at the cost of returns to the fund, I think in the long run, even to that particular fund, it will enhance deal flow, it will enhance reputation, and in general, there is no reason to be a jerk and hold back a tranche that is already committed. However, when it is not committed capital, but capital that you need to make a decision on, it is a little easier when you're a smaller fund, because then you can say that I have, we don't have reserves for this company. We are a smaller fund. We come in the seed stage. We want larger funds to take the company on from there. So it's a little bit less of a signaling risk if Anand or I do it. It's a much bigger signaling risk if Prayank does it, not support a company in Series A. But in the end, I think intellectual honesty here demands that if it is not committed capital, you need to go with your conviction and not the borrowed conviction from somebody else. That, like Anand was saying, you are a shareholder in WeWork and you realize that the company is not working out. Just because SoftBank is coming in, if you invest, I believe it's actually a breach of your fiduciary responsibility to your LPs. So I would actually, one thing.
Ritesh, what you realize?
to do it. There's no one way to do it, but just one example. What we do at Stellaris is that we actually hold an IC meeting for follow-on investments as well, every time. So the same process, while we don't go into the same level of external diligence, but the same process that is there for new investments happens for follow-on investments as well, which means the company comes and presents, everybody asks them questions, the deal team or the board member actually then has to justify why we are making or proposing to make another investment. And we go through a formal voting process like we do in a regular IC for a follow-on investment as well. That way, at least you maintain a semblance of objectivity. Yes, I don't see, I do think that there is a potential loss of reputation when someone else is willing to invest in your company and you're not willing to invest. But like I said, I think it's our fiduciary responsibility to not invest when we are not convinced. Sorry, Anand.
Ritesh, I think what we do internally is we allocate at least some amount for the next round from seed to Series A, assuming that you will have to give a little bit of money anyways, regardless of the performance. If the company is meeting your expectations, etc., then you try to do super pro rata in Series A. If it's not going well, you had already committed that amount. You may reduce the amount a little bit, but I think a practical solution is that don't do zero, because it does affect deal flow if you do zero participation right away at a Series A. So it's, I mean, of course, not the right thing, and sometimes we feel the same way, like you're saying. It is our responsibility to not allocate capital on things we're not comfortable with. But if you decide this beforehand and saying that, okay, I'm putting $1 million now, but then I will be forced to put at least $500,000 next round. So let's decide about 1.5 right now in seed stage. Not optimal again, but a little bit of contribution sort of, helps sort of maintain some whatever soft aspects with the founder in general.
Absolutely fair, Anand. And in fact, this is a very rare situation, to be honest.
Yeah, it's a rare situation.
This is a situation where your judgment is contrary to everyone else's judgment in the industry, right? Those situations, when they happen the other way around, when nobody else is convinced but you are convinced, we come out as heroes.
Yeah.
Right?
So
because then we would do an internal round. Yeah. We would end up making a huge return on that company if it eventually works out. And that is sort of true contrarian investing.
So I think you need to support the company for one round extra. And to that extent, you should not be jumping to conclusions within, like, you probably watched the company for 12, 18 months only. But 2 rounds from where you started, you probably don't have an obligation, and all the support and all is not required also. And by the time, you should know better anyways, regardless of outside connection.
Absolutely.
I think there is a reverse problem of this as well. So
we cannot hear you.
Clear, Madhukar?
No. Madhukar, there's an audio problem from your side. It's not about clarity. There is.
Hello?
Yeah, now it's better.
Yeah. So there is a reverse aspect of this problem as well, that you are a seed investor. You went into the company, you got 10, 12%, 13% in the company. And then the period from where you have invested to the time when the next round happens, right? You have not really built a view on the company. And now you're trying to build a view based on the incoming investor, right? So your call is on the coming investor, not on the company. And that creates a lot of confusion and problem, whether you want to do pro rata, whether you want to do more than that. So as a practice at India Quotient, what we do is that the first check when we write, that mistake we are allowed to make, right? So if you can go wrong, and that's no problem, but from the first check you write, next 12-15 months, you have to always be in a frame of mind where you are constantly taking a call whether if an investment happens today, would I want to put more money, or I want to sit out of this, or I would just do pro rata, right? And this evaluation, if you keep doing on the business level instead of waiting for a term sheet to come, then it is much easier, right? The semantics of that for whether you want to do a little bit so that you are not hurt in terms of your firm's reputation, etc., is that you can make a policy on a firm level. But I think the most important thing is that you have to know and you have to take a call on the business rather than the signal, right? And if you are able to build a process where you can make that decision on the business, then mostly it turns out better.
Yeah, absolutely. And to me, the chart on the left that I've shown actually illustrates the cost of not being ruthless in this decision making. I mean, in the extreme case, if we allocate capital to every company, and we say that no matter what, we will keep investing in the company till this amount, even if your underlying portfolio is superb, you make a 2x fund, is my point. And now, of course, the reality lies between these two extremes. But every time we invest in a company that actually, in our judgment at that point, doesn't deserve to get that dollar of investment, we are stealing that money from a company that does deserve that dollar. That was my broad point here. Sorry, I was speaking on mute. I will move on. The other concept I wanted to introduce, and which is also a very key decision that needs to be made multiple times in a year, is that of a return threshold. Now, all of us are VCs and we understand that there is a return threshold for VC. Many entrepreneurs don't understand this bit, but unless a firm can return a certain amount for us, even if otherwise it has all the ingredients, it doesn't become an investable entity. What I wanted to show was what that amount is and what that bar, how that bar varies with various considerations. So I have on the x-axis here taken the probability of picking a winner. 2 out of 10 companies, 1.5 out of 10 companies, or 1 out of 10 companies ends up being a winner. And in that scenario, this is the 3x portfolio that I had created in the middle bar in the last slide. For that kind of a portfolio, 3x portfolio, how does your bar change based on your probability of picking a winner? So if 2 out of your 10 companies end up being winners, then you have a minimum bar of 1/2x of the fund to come from every company that you invest in. Which means that, let's say if you're a $100 million fund, you are looking for a $50 million output from every company that you invest in. However, if your probability of picking a winner is 10% rather than 20%, then that bar moves to 1x. Now, a few obvious things here are that you cannot, the triaging that I spoke about earlier, you can't do this triaging at the first investment, which means that it's not that some companies can meet a 1/2x bar and some companies can meet a 1x bar because you don't know which are the winner companies beforehand or which companies have a higher probability of being a winner, which basically means that you have to apply the same bar to every company. To me, this is a hugely important criterion that one needs to be disciplined about while picking companies. We very often tend to fall into this temptation that this is a safer investment than the rest of our portfolio. So for this investment, the bar should be lower. I have not come across a fund where particular investments at the same stage, we had the ability to predict that these are safer investments versus these are riskier investments. So my strong recommendation is to apply the same bar to all the companies at the same stage of development, and keep that bar, decide on that bar upfront based on your portfolio construction. Because while you're in the heat of the moment, it is much, much harder to come up with a bar than it is to come up with it a priori. The other thing I'd like to mention is that the earlier stage you are as a VC, the higher this bar is, because by definition, a seed stage fund will have a lower probability of picking a winner than a Series B fund. Sorry, just 1 second, please. Yeah. By definition, a seed stage company will have a lower probability of picking a winner than, let's say, a Series B stage fund, which also means, which is actually which gives rise to a very interesting dynamic, which is that the absolute amount of money that you need to make from a particular investment remains relatively constant, whether you the bar for that, whether you invest in the seed round or the Series A round or the Series B round. I'll model this in the next slide. But one of the reasons that happens is because larger funds can increase ownership in their companies later on. So if Prayank and I enter the same company, I need to have a higher bar for how much to own upfront, because Accel, by virtue of being a larger fund, can actually invest a little more in Series A and get to that level of target ownership. Whereas I might not have that luxury to do a large super pro rata in Series B, in Series A, and then go up to Series B and Series C, which means that the bar is also different for the smaller fund versus the larger fund. I would argue, and actually I had a chat with Prayank, the bar for a fund like Accel is probably going to be somewhere in the 0.3 to 0.5x of their fund size. The bar for a smaller fund like Stellaris will have to be 1x of the fund size, because we make riskier investments in general. And so the probability of picking winners and the probability of being able to increase ownership is lower than it is for a larger fund. And here I have found that perhaps the biggest decision which influences whether you can get the 1x or not is actually the decision to syndicate at entry. It is there is, like everything else, there is a huge trade-off. If you feel that the company needs more capital than you can provide, both in this round and going forward, then you might not have an option but to syndicate. Also, if the other fund that you're syndicating with brings something unique to the table, then it might be better to syndicate. But I have found that perhaps the biggest lever in the difference between a 0.5x and a 1x, or a 0.7x and a 1x, if all goes well, is actually the decision to take that risk and do that investment yourself versus syndicate it. So I'll pause for questions at this point.
Yeah, just to dumb down a little bit of what Ritesh has said. Basically, what Ritesh is saying is that when you look at a company, and you say, if I'm going to invest in this, what is the expected outcome should I get out of this company? Only then I should invest in this. If, for example, if you are if I want 3 of my companies to return the fund, and let's say Accel is a $600 million fund, for example. So each company should return $200 million. And if I own 15% or 10% in that company at exit, this company should have the potential to be at least a $2 billion company. If it is not meeting that criteria, then I should not invest in this company. That is what Ritesh is kind of trying to say.
Yeah, I have another perspective on this, Ritesh and Prayank. The challenge is that if you have a lower bar and you say that I expect this company to be like a $500 million outcome, then given that most of the funds that will follow on after you are reasonably larger funds, even if the company had a decent enough chance of reaching $500 million exit, they will not be able to raise money from a good quality fund, right? So that sort of so in any ways, what we do is we try to cater to the next stage of the market, saying that who are the likely investors in the next round of funding of this company, and at least think through till Series A and B. and then what would be their expected outside of outcome, and then am I making the right decision or not? I mean, not to say that there is nobody who wants to invest in a $5 million outcome, but those are more like private equity guys, and a VC fund will still aim for a $2 billion, $3 billion outcome minimum per company.
100% right. Yeah.
I think it's very heavy duty today. I think we should conclude. Ritesh,
Sure.
You've gotten very, very good complex concepts, both of you.
Okay, I have one more slide.
Yeah, sure. Let's do that. Yeah.
This is a real example of one of my most successful investments from the past, where this is the capital invested is in the blue bars at each round, and the return on that capital eventually is the orange line. So as you can see, the $500,000 amount invested at seed had a 34x return, and that return came down pretty dramatically both between seed and A, and then between A and B. So this gives rise to one very key question: how much should you reserve for your portfolio company follow-ons? There is one extreme which says that you should deploy everything at seed because the 33x return will take care of everything else. That results in a spray and pray strategy that sometimes seed funds have. It's a very sane strategy, which basically says that if you give $500,000 to 80 companies, you're going to be able to deploy a $50 million fund quite successfully. And then even if a small number of those give these kind of returns, your portfolio return will be quite good. The other extreme that I've heard, and these are both from actually Indian investors, the other extreme is that we need to support our portfolio companies in every round because it is so hard to find a winner. When you do discover a winner, you must ride the wave all the way because the companies end up surprising you on how large an exit they can create. So the key question then becomes, when do you stop supporting a company? And the underlying question is your capital better utilized in earlier rounds or later rounds? The bar that we use internally is that the moment when the expected return from the expected risk-adjusted return from that particular round of investment becomes lower than the targeted fund return, then we don't invest anymore. But till then we do invest. So to give that to put that in context in this company, for example, if let's say at Series B there was a 60% probability of making this 3.3x, that would mean that would mean an average risk-weighted return of around 2x, which would obviously not meet the bar for the fund. Whereas in Series A, in the same company, if there's a 50% probability of making this 9.8x, that still meets the 5x benchmark for the fund, and it's a worthwhile investment. So we take that call, based on what is the expected return from this point on. And of course, we have to keep a rule for risk management purposes that no more than a certain percentage of the fund should go into one company. In this context, I did want to talk about this conflict between the GP and the LP. If you think about new fundraisers, for example, it might argue for not investing in the next rounds, which increases your firm numbers at this point. Second, one of the fundamental conflicts in our industry is that LPs care about IRR, but GPs get incentivized for the multiple because their carry is linked to the multiple and not to the IRR. So GPs in particular sometimes tend to not give weightage to the time it takes to get to a certain number. So might be tempted to take more risk and invest more in earlier rounds because they don't care how long it takes to get to that number if they were being mercenary about it. And the third, like we mentioned, is firm reputation. That what might be great for your fund's reputation might not be for the returns for the LPs. So these also become considerations. To avoid these conflicts becomes a consideration while deciding the reserve ratio for your fund. Happy to take questions at this point. I have no further material.